Looking out at the 2026 landscape, this is kind of the big conversation right now, is estimates kind of all over the board. Here's a chart of Wall Street's S&P 500 forecast for 2026, and estimates range from anywhere between a 3% advance to a 18% advance, but they're all positive. Nobody expects a down year ever on Wall Street, so again, not surprising. Again, it's a wide range. Kind of the average expectation is somewhere around 9-10% this year, returning back to more normal average returns after 3 years of near 20%.
Wall Street's always out there guessing. Like you said, what are they, 9% this year? That's right in line with the historical average. It's an easy guess. A couple of them are 18, one of them I think is down at 3 or 4%. We can guess all we want, and it doesn't matter. What matters, in my opinion, is just thinking about the events that we know will come to fruition throughout this year. And then you can try to think about some of the other possible events that will occur. The problem with that, I guarantee you, is that there are going to be things that are going to happen that were on no one's estimates, no one's bingo cards. So I think it's just wise to think about the big ticket items and what potentially the market has in store. On average, there's an 11% drawdown from the first day of January. On average, we closed 9% higher. At one point, we're up 16% on average, but there is one point in time where we're down 11%. So that's a lot of volatility in a normal year. Also important, we've had 3 years in a row now of a winning streak. Going back to 1928, we've only had 5 years where we've had more than 4 years or more. So this winning streak, it's not a problem. It's just something to think about, that we're starting to get into rarefied air here with how many years in a row the market can go up without taking a break. So my biggest concern, Lance, I know you've been voicing this a lot, is just valuations. Before we talk about what the Fed's going to do, what President Trump will do, Congress, midterms, all that, you just have to kind of look at the environment. And valuations are very high. And I could have picked out 100 graphs to paint the same story. But the risk is that even if earnings stay the same, that the multiple price that investors are willing to pay for $1 of earnings just comes down. And you end up with a down year. The economy can be fine. Earnings can be fine. There doesn't have to be bad news. There just has to be a change in investor sentiment to some degree. And remember, these magnificent stocks are now a good chunk of the S&P 500. So you just need a valuation adjustment in 5, 6, 7, 8 stocks. Other stocks may be fine. Let's just say valuations do regress back towards the norm. The market's down. Not everything is going to be down. Understanding kind of this rotation game between sectors, between factors, between types of stocks could be a critical portfolio risk management tool this year.
Catch me daily on The Real Investment Show. The link is in the description.